Hello and welcome to our channel. Since the Federal Reserve started raising interest rates a year ago, Wall Street strategists like Michael Hartnett of Bank of America have been warning that strong tightening of monetary policy always breaks something. In 1987, after a long time of going up, the stock market crashed. In 2000, the dot-com bubble burst. In 2007, when the Fed raised interest rates, this helped pop the subprime mortgage bubble. Hartnett has been saying for months that the Fed's new plan to fight inflation will lead to some kind of credit catastrophe, which will cause stocks to fall, spread to other markets and economies, end the bear market, and finally bring about the start of a recovery. Silicon Valley Bank, a little-known Californian lender that helped half of all venture-backed companies in the U.S. and 44% of venture-backed technology and healthcare companies that went public last year, went into receivership on Friday night, just days after trying to raise money to make up for huge losses from the sale of bonds and other securities. Is the failure of the second largest U.S. bank the credit event we've been waiting for? I repeat, of the failures of Bear Stearns and or Lehman Brothers, which caused the great financial crisis. At the moment, these worries don't seem to be valid. Still, this collapse will have big effects on the economy, both in ways that were expected and in ways that were not. Large banks are in a good place. The good news is that, while the speed with which this collapsed is scary, it also shows how quickly bank regulators in the United States are ready to act to stop the spread of problems to other banks. SVB could have wasted a few days looking for a bailout or a buyer, but instead, the California Department of Financial Protection and Innovation moved quickly, closing SVB, appointing the Federal Deposit Insurance Corporation as receiver, and promising to reopen branches on Monday. A sale to another institution is likely to happen in the coming days. It's also important to know how big SVB is. It has assets worth about $212 billion, which is less than a tenth of what J. Morgan has. So even though this has hurt the big U.S. banks, Bank of America fell 11% last week, Goldman Sachs fell 8.5%, and JP Morgan fell 7%, though its shares rose 2.5% on Friday on reports that many of Substack sector customers were trying to switch to Jamie Dimon's shop. They are still in a good position to weather any storm. Lotfi Karui, a credit analyst at Goldman Sachs, says, "This is not your older brother's systemic risk repricing." He is talking about the fears about the GFC. "We don't think it's likely that a problem with a small bank will spread to a large bank because there aren't many regional banks in the institutional-grade credit market. In the same way, there is not much chance that a capital or liquidity event will happen at a large bank." Sub's journey, as is well known, Sub's unusual position put it in a position where rising interest rates hurt it twice as much as most other banks. As the go-to bank for Silicon Valley startups, its deposits grew from $61 billion in December 2019 to $189 billion in December 2021, thanks to the pandemic's ultra-low rates and stimulus measures. Central banks set off the biggest fundraising boom for venture capital in history. This helped SVB make more than 3 times as many loans, bringing the total to $66 billion. The rest of the money was invested in different securities, such as U.S. Treasuries. But as interest rates have gone up, 2 things have happened. First, the value of technology has dropped, which has made it harder to get money and made it more likely that IT companies will ask for deposits. Second, the sharp rise in interest rates and bond yields over the past year has made the bonds SVB was holding as collateral for its deposits worth a lot less. Bond prices fall as yields rise. SVB had to sell its bonds at a big loss so that cash-strapped startups could get their money back. This led to its failed attempt to raise money last week, which led to widespread worries about its finances, which led to a rush of tech companies trying to get their money out of SVB, which forced regulators to step in and stop the bleeding. Even though few other banks have as much exposure to the technology sector as SVB, there is concern that many smaller banks also bought a lot of bonds before the Fed's tightening cycle at prices that now look like generational highs but are worth much less. Smaller regional banks in the U.S. have sold off a lot, and the KWBTF, which tracks these banks, fell 15% in a week. But individual falls are much bigger. Signature Bank stock in New York fell 23% on Friday night and more than 40% last week. PacWest Bancorp stock in Los Angeles fell 52% in just 2 days. In the next week, there will be a lot of attention on how safe and stable these regional banks are. and this is likely to have a big effect on bank stocks all over the world. Expect contagions to show up in both unexpected and expected places. Take the huge Swedish pension fund Electa, which manages assets worth more than $104 billion. It recently said that after 71 years, it was leaving one of Sweden's most conservative banks, Svenska Handelsbanken, and going into niche U.S. institutions instead. It was SU's fourth largest shareholder, and it also has big stakes in Signature Bank and First Republic Bank, whose shares fell 34% last week. Startup event on the verge of extinction. Most obvious are the effects on the tech industry, where banking with SVB was seen as a badge of honor and another sign that you had made it to the big tech stage. If a startup didn't get their money out of SVB before it closed, they will have to figure out how to pay their employees in the next few days. As the Australian Financial Review's Jessica West wrote on Friday, many Australian tech companies tried to do this. Gary Tan, CEO of the venture capital firm Combinator, took to Twitter to ask regulators to keep the receivership as short as possible. He also told them that he was worried that 30% of the companies he had invested in that had business with SVB would have trouble paying their employees in the next 30 days. He said, "This is a disaster for startups on the level of extinction, and it will set startups and innovation back 10 years or more. The big tech companies won't care. They don't have money here. If we don't find a solution, all of the startups of today, the Googles and Facebooks of tomorrow, will fail." Is this a response from the heart? Possibly. Concerns about payroll won't just be limited to the tech industry. On Friday night, Rippling, a U.S. payroll service provider that uses SVB to help process payments, had to tell customers that some payroll processing had stopped. Also, it's important to remember that SVB was a one-stop shop for tech founders. Many of them used it for personal banking needs like mortgages and other wealth management products. So, along with worries about the business, this is likely to cause a lot of personal stress. Ryan Gilbert, the founder of Launchpad Capital, says that the fact that SVB is a one-stop shop for the startup industry is a big advantage that will make this crisis worse. Over the years, one of the good things about SVB has been that I've been able to take care of the needs of general partners, limited partners, and all of the founders, as well as their businesses, he told CNBC. That's part of the problem. That was the key to success, but it also played a role in the sad end. If the SVB keeps looking into what went wrong in the next few days, there will be plenty of blame to go around, and the bank can definitely take some of it. Gary Becker sold $3.5 million worth of stock last week. At a conference last week, he talked about how the bank takes pride in being the best financial partner in the most difficult times. It has also been found out that the bank didn't tell the market for months that its stop risk officer had left last year, which would have been a major red flag. But the industry of venture capital should also look closely at itself. Even though people talk a lot about being different and finding long-term patterns in the sector, it often moves like a herd, with everyone trying to do the same thing at the same time. Gilbert of Launchpad is right when he says that the startup industry has become too dependent on a single bank. And as everyone ran for the door like a herd on Thursday and Friday, Subzen was sealed. Many people will also criticize the Federal Reserve for keeping interest rates too low for too long over the last 10 years and then raising them too quickly in the last year. Putting aside the fact that the banking and venture capital sectors have clearly failed at risk management, Macquarie strategist Victor Schvetz argues in a new note that the Fed is handling the normalization of rates and inflation in the wake of the pandemic so well that it deserves the Nobel Peace Prize. Before COVID, the Fed had 3 goals. Satisfy public demand to avoid a deflationary bust through 2020-21. Make sure that economists don't have another deflationary bust when COVID ends in 2022-23. And bring down the inevitable inflationary spike caused by an unprecedented shift in the demand and supply curves for goods and services as well as labor markets, with as little damage to either real or financial markets as possible. The US CPI is getting a lot of attention. After Friday night's US jobs report, which showed more jobs than expected, but also more signs that wages are falling, Schvetz thinks the Fed is about to stop doing what it's supposed to do. Everyone will be watching the US CPI report on Tuesday night, but we still think that most leading indicators continue to point to deflation. Falling money supply, weakening credit momentum, falling real deposit balances, flat to falling commodity indices, removal of the last supply chain bottlenecks, rising state claims, and less wage pressure, even in service sectors. If nothing else goes wrong, inflation should more than double in the next 12 months without a big drop in demand or a lot of capital going down in value. This may be as close as anyone could have gotten to a perfect outcome 4 years ago. It could also show that Putin's view that real assets are better than what he sees as a decadent Western financial world is wrong, which could earn the Fed a Nobel Peace Prize. We're not sure if Federal Reserve Chairman Jerome Powell deserves this honor just yet. Inflation seems to be too stubborn to declare victory just yet. And the SVB situation shows that we haven't seen the full effect of higher interest rates on the real or financial economics. We won't say for sure that Schbet's prediction will be very accurate when we look back at the Fed's work from 2020 to 2025 in 5 years. But for now, what Michael Hartnett of Bank of America calls the crashy vibes of March are likely to remain the most important story. Thank you for watching, and remember to let us know what you think this means to our financial system. Don't forget to like and subscribe.